Returns, lessons from the past. John sits at his desk, staring at a single $1 bill. He already understands the power of compounding and how to discount future cash flows. But now he faces a deeper question. Where should he actually put this dollar so that, decades from now, it grows into a fortune? John has heard that stocks are the best path to wealth. But he's also heard horror stories of people losing everything in market crashes. To make a decision based on facts rather than rumors, John decides to look at the past. He turns to financial history, which Brealey, Myers, and Marcus describe as the ultimate teacher for any investor. Imagine John has a time machine and travels back to the year 1926. He has three options for his dollar: United States Treasury bills, government bonds, or common stocks of large companies. If John chose the safest path, Treasury bills, which are essentially very short-term loans to the government, his risk would be virtually zero. The United States government always pays its debts, but there is a price for this safety. By the early 2020s, that $1 would have grown to roughly $20 or $25. At first glance, that looks like a decent gain, but then John remembers inflation. Over those 100 years, prices rose so much that the purchasing power of those $20 is barely more than what his original dollar could buy in 1926. Lesson 1. Total safety often means zero real growth in wealth. Next, John considers government bonds. These are longer-term loans to the government. They are riskier than bills because their market price can drop when interest rates in the economy rise. However, for taking on this extra risk, the market offers a higher return. That same dollar invested in bonds would have grown significantly more than in bills. But the real magic, or the real chaos, depending on your perspective, begins when John looks at the stock market. Common stocks represent ownership in companies. If John buys stocks, he becomes a part owner of businesses. If the business thrives, John gets rich. If the business fails, John loses his investment. By investing $1 in the S&P 500 index in 1926, John would see something incredible. Today, that single dollar would have turned into several $1,000s. Even after adjusting for inflation, the growth is colossal. However, the path to this wealth was not a straight line. John sees deep canyons on the chart. The Great Depression of the 1930s, where stocks lost over 80% of their value. The 1970s oil shock, the dot-com crash in 2000, and the 2008 global financial crisis. Here, John encounters a fundamental pillar of finance, the risk premium. Brealey, Myers, and Marcus explained that the difference between the return on stocks and the return on safe treasury bills is called the equity risk premium. Historically in the United States, this premium has averaged around 7 to 8% per year. This is the reward the market gives John for agreeing to endure sleepless nights when the market plunges. If the returns on stocks were as low as bills, no one would buy them and risk their hard-earned money. John begins to realize that average return is only half the story. Volatility is what matters. He notices that in any single year, stock returns could be plus 30% or minus 20%. But the longer John holds his investment, the more likely his average annual return will move toward the historical averages. This leads him to the idea of the opportunity cost of capital. When John decides to invest money back into his keyboard business, he must ask himself, will this project earn me more than I could make by simply putting this money into a stock index with a similar risk level? If his business only promises a 5% return while the stock market's historical average is 10%, John is effectively losing 5% every year by being a manufacturer instead of a passive investor. History teaches John another vital lesson. Nominal return and real return are two different things. Nominal return is the number he sees on his bank statement. Real return is how many burgers he can actually buy with that money. During periods of high inflation, like the 1970s, stocks might have gone up in nominal terms, but their real value dropped. This makes John cautious and reminds him to always factor inflation into his long-term goals. As he studies the charts of the last century, John sees that markets are unpredictable in the short term, but show remarkable resilience in the long run. He understands that risk is not something to be avoided at all costs, but something to be managed intelligently. Past performance does not guarantee future results, but it gives John a logical base to estimate probabilities. Now that he sees the massive gap between the wealth accumulated in stocks versus bonds, he recognizes the sheer force of compounding over long time horizons. John realizes that to build wealth, he doesn't need to be a prophet. He needs time, discipline, and the understanding that every percentage of return is paid for with a willingness to see red numbers in his portfolio during market storms. He closes his book on market history with a clear realization. His dollar today is a seed that can grow into a massive oak tree, provided he chooses the right soil and has the patience to weather the storms. He is no longer just saving money. He is positioning his capital where history suggests it has the best chance to flourish.